So, let's dive into a really important accounting concept, asset impairment. Think of it as a company's financial reality check, a way to find out what its assets are truly worth, not just what they wish they were worth.
You know, when you look at a company's balance sheet, you see all these assets listed. Factories, machinery, maybe even big brand names. But you have to ask yourself, is a factory they built 20 years ago really worth what the books say it is? Especially if some shiny new technology has come along? Well, that's the exact question asset impairment is designed to answer. So, what is it exactly? Well, asset impairment is basically an accounting rule that stops companies from overstating the value of their stuff. If an asset's value takes a nosedive, the company has to write it down to reflect its new, lower value. It's like a mandatory dose of realism for the financial statements.
Okay, so how does this reality check actually work in practice? It all comes down to a really straightforward comparison, a test, really. This test pits what the books say an asset is worth against what the company could actually get back from it.
On one side of the ring, you've got the carrying amount. That's just a fancy term for the value of the asset as it's sitting there on the company's books. And on the other side, you have the recoverable amount, which is the actual economic juice the company can expect to squeeze out of that asset. If that carrying amount is higher than the recoverable amount, you've got an impairment. It's as simple as that.
Now, this is where it gets interesting. How do we figure out that recoverable amount? It's not just one number. The company has to do two calculations. First, they figure out the asset's fair value less cost to sell. Basically, what could they get for it if they sold it today? And second, they calculate its value in use, which is all the future cash they expect to make by keeping and using it. The recoverable amount is whichever of those two numbers is higher.
All right, let's make this super clear with an example. Look at asset B with me. The carrying amount, what's on the books, is $150,000. Now, we compare that to its recoverable amount. We look at its sale value and its value in use, and we pick the higher one, which is $130,000. See the problem? The book value is $20,000 higher than what they can actually recover. So boom, the company has to record a $20,000 impairment loss. That's the core calculation right there.
Okay, so companies don't just run this test on every single asset all the time. That would be a nightmare. Instead, they have to be on the lookout for specific red flags, these indicators that an asset's value might have dropped. And these clues can pop up from both outside and inside the business.
First, let's talk about the signs from the outside world. If an asset's market price suddenly tanks, well, that's a huge red flag. Same goes for big negative shifts in the economy or technology. Just imagine a new invention comes along and makes your factory's main machinery totally obsolete. Even something like rising interest rates can trigger a test, because it messes with the value and use calculation.
And then you've got the clues from inside the company. The most obvious one, of course, is physical damage to an asset. But it could also be a big strategic decision, like if management decides to shut down an entire division. Or, let's say a machine is just constantly underperforming, not producing what it's supposed to. That's a crystal clear signal that its value probably needs another look.
Now, it's not always a one-way street down. The world of asset impairment has a few more wrinkles, especially when an asset's value bounces back, or when you can't really test an asset all by its lonesome.
So what happens if the market turns around and an asset's value actually goes back up? Well, in a lot of cases, a company can actually reverse a previous impairment loss, which is pretty cool. It adds some flexibility. But, and this is a big one, there is one major exception: goodwill. You know, that fuzzy, intangible asset that represents a company's brand or customer loyalty? Once you impair goodwill, it's gone for good. You can never reverse it. You know, sometimes you just can't test a single asset because it doesn't make any money on its own. Think about one single machine on a huge assembly line. So what do accountants do? They group assets into something called a cash-generating unit, or a CGU. It's simply the smallest possible group of assets that works together to bring money in the door.
And this is a perfect way to picture it. For a big restaurant chain, a single restaurant location could be a CGU. All its parts, the building, the ovens, the tables, they all work together to generate cash. For a mining company, you can't just value one truck by itself. Its value is tied to the whole operation, so the entire mine becomes the CGU.
So what happens if an entire cash-generating unit is impaired? How do you spread that loss around? Well, there's a specific pecking order. First, you have to wipe out any goodwill that's attached to that unit. Take it all the way to zero. If the loss is even bigger than the goodwill, then you start allocating the rest of the loss across all the other assets in the unit based on their value.
All right, so after all these rules and calculations and CGUs, we gotta ask, why should we even care? Well, it's because asset impairment has a very real, very direct impact on a company's financial health, and maybe more importantly, how investors see that company.
So, what's the direct hit? An impairment loss socks a company's financials in two places at once. First, it's counted as an expense, which reduces the profit for the year. And second, it lowers the asset's value on the balance sheet. It's this double hit that gives us a much more honest, truthful picture of where the company really stands.
So here's my challenge to you. The next time you're looking at a company's annual report and you see a big impairment charge, don't just gloss over it. Stop and ask yourself, what's the hidden story here? Is their technology getting old? Is a market turning against them? These write-downs aren't just boring numbers. They are stories about a company's challenges, its strategy, and its connection to the real world.